In this video, we're going to talk about how to account for investments in equity securities. So let's say that your firm decided to invest in Microsoft. How would they go about accounting for their investment? Well, it depends on the percentage of Microsoft shares that your firm ends up buying. So for example, let's say that you buy 10%. Let's say that that's your ownership stake in Microsoft. If you buy 10% of Microsoft shares, then you're going to be deemed to have little to no influence over Microsoft, right? If you owned 100% of Microsoft, to the contrary, you would have all kinds of influence. You would control the company. But if you own less than 20%, from an accounting perspective, we're going to say that you have very little influence on this company, if any. Then the method for accounting for your investment is going to be called the fair value method. And by the fair value method, what we basically say is that you're going to debit securities and then credit cash, or however you decide to pay for this. But let's just say you paid cash. You just debit securities and then credit cash. And then you're going to have, as you hold this investment, you're going to have unrealized gains and losses, right? Because the stock price of Microsoft is going to fluctuate up and down. So end of the quarter, end of the year, you look and you see, hey, I've got this unrealized gain or unrealized loss on my stock. Now, how you account for those gains and losses depends, right? So basically, there are two types of these fair value method securities that we can have. You can have trading securities, which are basically, if you say, hey, you know what, I actively trade these securities, I plan to probably sell this Microsoft stock within the next year. I'm just wheeling and dealing. I buy and sell securities frequently. So then you say, okay, it's a trading security. So the unrealized gains or losses, they would go to the income statement, right? So they would flow through net income. So I'll just abbreviate here, net income. It's where these trading gains and losses would go. Now, if it's not a trading security, if you say, you know what, I don't know when I'm going to sell this Microsoft stock, then it would be what's called an available for sale security. That's the other type that's under this fair value method. So in that case, the unrealized gains and losses is going to go to an account called other comprehensive income, which is it's going to flow through equity ultimately, but it's bypassing the income statement. So it's not going to go through net income. So you're not going to realize any gains or losses on this available for sale account through net income until you actually sell those securities and realize an actual gain or loss. We'll get more into that when we have individual videos on trading securities and then the AFS securities. But for the time being, so let's just focus the next thing. If you're at 20 to 50% ownership, right? So let's say that before we were talking about you own like 10%, less than 20, but let's say that you own 40% of Microsoft, right? So now you're in this 20 to 50 threshold, and then you would be deemed to own a significant influence on this company, right? You have a significant influence on Microsoft if you own 40%. So then the method that you would use for accounting, you would use what's called the equity method. And with the equity method, essentially what you're going to do, instead of tracking unrealized gains and losses like we did under the fair value method, what you're going to do is you're going to recognize a proportionate share of Microsoft's net income every quarter, every year. So if Microsoft has $100 of net income and you own, let's say you own 40%, then you would have $40 of net income that you would receive. And so that net income is actually going to increase the carrying amount of your investment. And then if Microsoft were to pay a dividend, then that would decrease the carrying amount. Now, I'll get into that when we have a video on that. But we'll just say here, so we'd have a debit. This is when you buy the Microsoft stock. Let me just cross this out for the minute. So when you buy the Microsoft stock, you just debit investment in Microsoft or something like that, and then credit the cash. Okay, and then this would be your carrying amount, which would fluctuate as you recognize that proportionate share of net income or as Microsoft pays out dividends. So you're basically taking your proportionate share of Microsoft's net income. Whereas with the fair value method, whatever Microsoft's net income was, that we didn't take a proportionate share of that. The only thing that was affecting us was unrealized gains or losses on Microsoft's stock. So as the stock price changed, we have unrealized gains or losses. Here, we're just saying we're going to take a proportionate share of Microsoft's net income. Now, what if we owned more than 50% of Microsoft? What if we bought 80%? So let's just say we bought 80% of Microsoft stock here. Now we're deemed to control Microsoft. We don't have to have 100%. Just more than 50% is enough to say that we control Microsoft now. And so the method we're going to use when we control a company is called the consolidation method. And this is actually quite complex, but I'll just give you the basics. What we're going to be doing is we're going to take 100%, regardless of how much control we have, whether we have 80, 90, 75. If we have control, if it's more than 50%, then we're going to take 100% of Microsoft's assets and their liabilities and so forth. And those Microsoft's assets now all become our assets. Microsoft's liabilities become our liabilities. It all comes onto our books. That's what consolidation is. We're taking their assets and their liabilities and we're making them our own.